So can we start? Okay. My name is Mr. Nyango Cosmus, and of course I usually teach this management accounting with another teacher. So today I decided to stand in for him for this first class. I believe that probably next week he will come back. So usually when he's not around, I stand in, and when I'm not around, also he stand in for my classes. So I'm going to do the introduction part of management accounting with you. So I can see some of the people are not new. We had already met some other guys in the previous sections. Geoffrey, how are you? How is your sister? So we are on the introduction part. Introduction to MA, management accounting. So what we are going to cover is basically to understand what this unit is all about. And thereafter, after we have understood what MA is all about, we are going to proceed and actually look at the differences that are there between MA and FA. And thereafter, then we proceed and look at another area, and that is CVP analysis. And why basically it is important at times to start with the CVP analysis before you proceed and discuss other areas, is that the knowledge that you acquire in the CVP analysis you'll then be able to use in other topics like cost forecasting and so on and so forth. So that's why I usually start with CVP analysis before I embark in discussing other topics in MA. Now, when we talk about MA, the name itself there suggests what it is. We are saying it is management accounting. So therefore, it means it's a management for the it is the accounting for the managers. So it means that it is an accounting that provides information for the managers to enable them to be able to carry out their functions. We know that the management carry out a lot of set of functions: planning, controlling, performance evaluation, organizing, and other things. So in the process of carrying out those functions, they need information, and so management accounting is the basis upon which they obtain information to enable them carry out those informations. So we say that management is basically a form of internal reporting, where reports are generated internally for use by the management, basically to enable them to carry out their various functions. You can say management accounting. Management accounting. So just brief items there. Is a form of internal reporting. It's a form of internal reporting. It's a form of internal reporting. It's a form of internal reporting whereby reports are generated internally for use by the management. So that's that. So management, so of course, management accounting. This management accounting, I say management accounting there, is a form of internal reporting whereby reports are generated internally for use by the management. So it's about, that's why we call it management accounting. With management, of course, the management team, they need the reports, and so these reports, they use them in making or carrying out their various functions. So of course, we have already seen that there are several functions that are carried out by the managers. We have the planning, deciding at present what you wish to do in the future, organizing, controlling, performance evaluation, and so forth. For management to be able to carry out those functions, they basically need certain sets of information, and that is provided by management accounting. So you can say say this enables the management to carry out their functions, which includes planning, controlling, organizing, performance evaluation, etc. So this information enables the management to carry out their functions, which includes all this. So that is about management accounting. We may proceed still on the introduction parts and discuss the differences between FA and MA. So briefly, you can write there differences between financial accounting and the management accounting. So you can say there differences between FA, financial accounting, and management accounting. So there we can have a table. And this table, this side you can have FA, and this side you can have what you call MA. So you can, from what we have seen that the management accounting is for internal, is actually the reports. The management accounting reports are basically used internally by the management. So the reports are actually for internal use, but for the financial accounting reports, they are for both internal and external users. So the internal users include the employees and the managers. External users include the government, competitors, suppliers, and so forth, and they use them for several reasons that we already seen in our earlier studies. So financial accounting reports are used for by both internal and external parties. You say the reports here, the reports are used by both internal and external parties. In this data side, the reports are purely for internal use by the management. So that's that. So for financial accounting, the reports are used by both the internal and the external parties. But for management accounting, the reports are purely for internal use, of course, by the management. Number two, financial accounting. Financial accounting is regulated. So we say it's regulated by statute. Statute is actually law. It is regulated by statute. So you'll be told, for example, it's a public company. You'll be told you have to publish the information annually, and those informations the law will tell us what is expected to be revealed by those informations. So, for example, you'll be told there must be the company must actually show a statement of cash flow statement, that is income statement, statement of financial position, statement of changes in equity, and other things. So the financial accounting is actually regulated by statute, but this other side, it is not regulated. It is not regulated by any law. So there is no law that regulates management accounting. There is no law that regulates management accounting. But the other side, it is regulated by statute. Under the statute, the financial accounting information or reports must always comply with the relevant accounting standards. They must comply with the relevant accounting standard. So the must FA reports must comply with the relevant accounting standards, i.e., e.g., international accounting standard. You set this aside, they are not subject to any standard. Now, what we are saying is that these reports for FA, they must comply with the relevant accounting standard, but for this one, they can actually be any form deemed fit by the management. So they are not subject to any accounting, they are not subject to any accounting standard. They are not subject to any accounting standard. So we are saying as an accountant, you must know you must be able to know the IAS that are actually available, because the information that you prepare for financial accounting must always comply with the relevant, with the accounting standards. For example, we have IAS 1. IAS 1 is about what? You should be knowing that. What IAS 1 is about what? Yeah? Cash flow. Cash flow is IAS 7. IAS 1 is about what? IAS 1 is about? IAS 1? So, as an accountant, IAS is like a Bible to a Christian or a Quran to a Muslim. You must know IAS because the preparation of these information must comply with IAS. So IAS 1, for example, is about how you're supposed to present the financial statements. IAS 2, for example, is about the inventory valuation, or how the inventory basically should be valued. So every aspect of the financial accounting is actually must comply with the requirements of the relevant IAS, but such is not there in the manager in MA. Number 4. FA is historical in nature. This is aside. MA is futuristic. Is futuristic in nature. Futuristic in nature. We will be signing from this thing as we proceed with our learning. Now, when we talk about FA being historical, historical means history, things that had happened in the past. So if you look at the statement, you are told the income XYZ Limited income statement for the year ended, past. Even the balance sheet statement of financial position as at, but the period has already ended. Historical is about history, historical. But MA is about the future. The management are concerned with what they are to do in the future. Planning is about the future. And everything that they are doing, performance evaluation that they are doing is about the future. So MA is more exactly futuristic in nature, but FA is actually historical. Number 5, you said FA reports, may be subject, say may be subjected to auditing, but this aside, under number 5, MA reports are not subject to any auditing requirements. So that's that. So for the financial, when we talk about auditing, when auditing is about, we are auditing the financial accounting reports, but we don't audit the MA reports. They are not subject to any auditing requirements. So basically, those are the differences that are there between MA and FA. So if you are told to highlight the differences that are there, you should be in a position to mention those differences. And that is the brief on that part of the introduction in MA. Now we know what MA is, and now we know the differences that are there between MA and FA. Now we proceed, as I said, that once I've discussed this, I'll proceed and discuss something else. And this is CVP analysis. As I've said, it's a very important topic because it will lay a ground for your understanding of other topics that we'll be discussing in the future. So CVP analysis. CVP analysis. CVP analysis. Now, C stands for cost, V stands for volume, and P stands for profit. It's a very important model that are used by the management, again, to enable them to make various decisions that are related to production. And so this model basically examines the impact of costs and sales volume on profits of a farm. So that's that. So we are going to discuss CVP analysis for a single product, and thereafter we also discuss it briefly in a multi-product situation. Now we start by understanding, of course, just like any other model, it is discussed based on certain assumptions that we are going to basically to analyze, to look at briefly, to look at shortly. So we say CVP, of course, I say C stands for cost, V stands for volume, and P stands for profit. So we talk, when we talk about cost is a composition of two things. We have fixed cost, which does not change regardless of the level of activity. Fixed costs will be able to pay them even at zero level of activity. We also have an element of variable cost. Variable cost per unit remains constant, but the total variable cost will change with the change in the level of activity. So it means that the more the level of activity, the more the variable cost that the farm will incur, and the less the level of activity, the lesser the variable cost that the farm will be able to incur. So we look at those cost structure, and we look at, of course, we examine the impact of the cost and the level of activity of the sales volume on the profitability. So we say CVP model examines. So model. So we say CVP analysis, not a model. CVP analysis is a model. That examines the impacts of costs and sales volume on profitability. On profitability of a farm. So what's the impact? Analysis. So as we are carrying out the analysis, there are certain assumptions, factors that we assume to remain constant. Factors that are constant, we are referred to as assumptions. So, one, cost is assumed to be linear. be linear and can be divided into fixed and variable components. So we assume that the cost is linear and we are able to divide them. We can actually, so we are simply saying we are able to separate fixed cost from variable cost. So cost is assumed to be linear and can be divided into fixed and variable cost. So we are able to separate the cost into fixed and variable components. Number two, the total fixed cost is assumed to remain constant. So the fixed cost will not change. So the total fixed cost is assumed to remains constant regardless of the level of activity. So the total fixed cost is assumed to remain constant regardless of the level of activity. So regardless of the level of activity, the fixed cost remains the same. Number three, the variable cost. So variable costs, the variable cost per unit remains the same, or constant, remains constant, but total variable costs changes or varies, changes with the change in the level of activity. So the variable cost per unit remains constant, but total variable cost changes with the change in the level of activity. Now, we may wish to understand what that is. What we mean by that. We have fixed costs like rent. The fixed costs are things like rent. You have to pay rent whether you are operating or not. You have to pay salaries for permanent staff whether they work or not. You have to pay them. Those are fixed costs. They remain the same regardless of the level of activity. But we have other costs which are variable. They vary with the level of activity. And such, basically, the total of variable costs will increase when the level of activity increases and vice versa. Now, suppose you have hired, let's say we take an example of a carpenter. And so you have agreed with a carpenter that for every furniture that he makes, you are going to pay him 500 shillings. Every furniture that he makes. Carpenter. That is direct labor. That's the direct labor cost. Right? All direct costs are also variable costs in this. All direct costs are also variable. So you have agreed that for every furniture that this carpenter makes, you are going to pay him 500. So if he makes 10 furnitures, how much are you going to pay him? 5,000? If he makes no furniture, how much are you going to pay him? 0 together. It's a variable cost. You can see that the variable cost per unit remains the 5,000, but the total variable cost will either increase or decrease with the level of activity. That is that. So we go to number 4. Number 4, you say, so number 4, so the fourth assumption you can say, number 4, only one product is considered, but in a multi-product situation, the sales mix remains the same. remains the same. So we assume that we are only analyzing one product. But it is possible that a farm may also be producing more than one product. And if that is the case, then we assume that the sales mix remains the same. The sales mix remains the same. The sales mix is simply the proportion in which you are producing the products. So whatever you are producing, you actually are selling. And therefore, we can call it the sales mix or the production mix. It's simply the ratio in which you are selling the product. So if we have three products, X, Y, and Z, and X, Y, and Z, these are multi-product. We're not dealing with that one product there. So suppose that we sold 100 units of that, and we sold 50 units of that, and we sold 200 units of that. 200 units of that. There is a ratio. 1, 2, and what here? 4. This is what we refer to as the sales mix. So when we are producing different products, we are assuming that for purpose of the CVP analysis, we assume that the sales mix remains the same, and the sales mix is the ratio in which we are selling this product. So that if at all you produced or sold 400 units, how much are you going to produce of Y? 200. And how much of this? 800. So we are assuming that only one product is considered, but in a multi-product situation, the sales mix remains the same. The sales mix, as I've said, is the proportion in which which one? Oh, so I was saying we have X, Y, and Z, senior. And so I'm saying here, what did I write here? 50, senior. And this one, units. Units, when I what units means, you are able to count them. How many? 2 books, 3 books, 4 books. So we talk about that. Instead of saying 2 books, we say 2 units, 4 units, because we can be dealing with several products. So here I talk about 200 senior units. So if you look at this, what is the ratio? It is 2 to 1 to 4 together. This ratio here, it is 2 to 1 to 4. So you assume that in future, if that is the case, whenever we are selling, whenever we are producing those 3 products, we are going to maintain this ratio. This is what we call the sales mix. So whenever we are selling these products, we are going to sell them in this proportion. Get it? So we proceed to number 5. And number 5 is saying the technique or methods of production or method of production does not change. So the methods that we are using in producing whatever we are producing remains the same. We assume it does not change. You can also say number 6, the level of activity. The level of activity is the only driver. Is the only driver for costs and revenue. So once the only driver, we are simply saying what will make the cost to increase or decrease is the level of activity, and the level of activity here is exactly what we are producing. So, and then whatever we are producing, we are going to sell. So when we produce more, we are going to get more revenue. So the level of activity is the only driver for cost and revenue. Number 7, the selling price. The selling price remains the same. Remains the same. So there are others who can also include. We also assume there is no closing. There is no closing inventory. Why that is because everything that we are producing, we are selling. So if everything we produce is being sold, then automatically we don't expect any closing inventory to be there. Now, those are the assumptions that are there in CVP analysis. So you can be asked basically to highlight the assumptions, or at times they talk about limitations. So if you are told the limitation is CVP analysis, they are basically these assumptions, but then you answer them in a way that brings in the limitation. For example, if you're told what are the limitations of the CVP analysis, you say it assumes that the cost is linear and can be divided into fixed and variable, but in certain cases, cost and semi-variable are actually semi-fixed. You can also say it assumes that all cost is you can also say it also assumes that the total fixed cost remains constant, but in certain cases, the fixed cost may change. So you are bringing the limitation there. It assumes that the selling price remains the same, but in practice, the selling price may, in reality, the selling price may change. So you are bringing the aspect of limitation. So you can be asked the limitation CVP analysis, the same points, but then you explain them in the way that I'm talking about. But you are told the assumptions, just pick those. Now, down there, you say, down below these assumptions, you say CVP analysis. Say CVP analysis can be represented diagrammatically as shown below. It can be represented diagrammatically as shown below. So you can be able to represent it diagrammatically as shown below. So we are able to represent, of course, this is what I'm talking about. So this is fixed cost. So I'm going to explain the diagram. So this is revenue and costs. This is the level of activity. We have, so you can see even at this level of activity, we are still incurring that fixed cost. So above that, we have total cost. We have total cost. So total cost, remember, is a composition of both fixed and variable. Then we have here, so this should be straight. So we have total cost there. This is sales revenue. This is DE. So this region is the region of profit. This region is the region of loss. This angle is referred to as angle of incidence, and it's also its importance. Now, then, of course, this is break-even point, but now in units. Then we can have a different level of activity there. So this is the actual, and talk about being the actual level of activity. Then the difference between the actual and the break-even point, we refer to as this as the margin of safety. So I'm going to explain that diagram. So you can draw it first, and then I do the explanation for that. This is sales revenue. Sales revenue. This is total cost. This is fixed cost. This is this side is level of activity. This side is revenue and cost. And then this one is the actual level of activity. This one. I'll explain all that. Okay? Margin of safety, I'll explain it. MOS is margin of safety, margin of safety, margin of safety. Now, assuming that you have drawn the diagram, let's look at what is happening. There's fixed cost here. It is constant throughout. And as we produce, we also incur what we refer to as variable cost. And we have said somewhere in the assumptions that the cost is linear and it can be divided into fixed and variable component. So we have cost, that is, this is cost A plus BX. So this is fixed cost, all of that is variable cost. B is actually variable cost per unit. So we have fixed cost plus variable gives you total cost. Then we have the revenue here, sales revenue. You can see that below here, below this is a point, this B is break even, B is break even point, this stroke is break even point. Now below this break even point, you're able to see that the total cost is higher than the revenue. The total cost is up here and the revenue is down there. So where the total cost is higher than the revenue, it is loss, because profit is basically sales revenue minus total cost. So it means that if the cost is higher than the revenue, there will be a loss. If the sales revenue are higher than cost, there will be profit. So below the break-even point, there is loss. It's a loss region because the total cost is higher than the revenue. But above the break-even point, you can see that the sales revenue curve has already overtaken the cost curve, and therefore the revenue is higher than the cost. It's a region of the profit. It's a region of profit. There's an angle here, and this angle we refer to as angle of incidence. The significance of that angle is that it indicates the rate at which the profit will increase after the break-even point. So if the angle is wide, it is an indication the profit will increase at a higher rate, and vice versa. Now, at this point, the break-even point, the revenues that are being generated are exactly enough to cover for the costs that are incurred by the firm, and therefore at this point the profit is zero. So there's no profit here. The profit is exactly zero because what is generated is exactly the same as it's actually enough to cover for whatever the costs that are incurred. So what happens in most of the cases that a firm will not be willing to operate at the break-even point. Every firm would be willing to operate at a point above the break-even point, where at least it will be generating or earning some profit. So the difference between the actual level of operation, the actual level of activity, and that break-even point level of activity is what we refer to as the margin of safety. Is what is referred to as the margin of safety. So we can actually be able to demonstrate the CV analysis diagrammatically as shown by that diagram. Now, that's that. Are you together? Or we are lost? Who is lost? Carry up your hand if you are lost. Nani? Oh, wait. Are you lost? Lost? Are you lost? No. Are you okay? So where are you lost? So if you are lost, kindly you don't keep quiet. Avoid the margin of safety. Margin of safety? I'm saying that no firm will be willing to operate at break-even point. No, because you operate so that you generate profit. So if at the break-even point you are producing 400 units together, at break-even point you are producing how many units? So you will not be willing to produce this because you want profit together, and so you may produce. Let's say you may produce the actual level may be 600 units together. So the margin of safety is the difference between this and that, which is 200. 200. Right there. So that's the margin of safety. The difference between the break-even point and the activity level is the margin of safety. So if the break-even point is 400 units and the actual level of activity, because we'll be willing to operate above the break-even point, the difference is what we are referring to as the margin of safety. We are all now on the same page. Sindio? So we proceed. And you simply say terms used in CVP analysis. So we are going to look at certain terms, and as we are also look at those terms, we also look at how we are able to compute them. So we are going to go step by step. The first thing we have what we call contribution. Contribution margin, CM. Contribution margin. Contribution margin, in short, CM. CM contribution margin. Now, it is also referred to as contribution per unit. It is also referred to as contribution per unit. So what is it? So the CM, the contribution margin, is saying it is the difference. It is the difference between the selling price. The selling price and the variable cost. Per unit. That's that. The difference between the selling price, of course, for each item, and the variable cost per unit. So what are we saying? So you can say it is obtained from the following formula. You can use this formula to get it. So CM is obtained from selling price. Selling price per unit minus variable cost per unit. Selling price per unit minus variable cost per unit. Now, what are we saying? If a furniture, let's say the selling price for a furniture is 8,000 shillings, and the variable cost that we incurred to produce this furniture is actually, let's say, it's 7,000 shillings. So the contribution margin will simply be 8,000 minus 7,000. That gives about 1,000. Simply the difference between the selling price for each item and the variable cost for that item. We already know what variable cost is. Variable costs are those costs which changes level of activity. So you can get it using this formula. CM, remember, is the contribution per unit. It's also a part of the contribution per unit. So you can get it using this formula, or we can also apply this formula in getting it. You can also get a CM from total contribution. We are going to see what this is. Divide by the number of units. So number of units are actually the level of activity. How many units, how many items are you producing? 1,000 items, 100 items. That's the number of that's the activity level. So we can still get it if you have the total contribution. We are still able to get the CM by simply dividing the total contribution and the total number of units. We are still able to get the same answer as the other one. Number two is total contribution. Total contribution. The second item is total contribution. And you say this is the difference between, the total sales revenue. It is the difference between the total sales revenue. It is the difference between the total sales revenue and the total variable cost. Is the difference between the total sales revenue and the total variable cost. Is the difference between the total sales revenue and the total variable cost. the difference between the total sales revenue, whatever the revenue that we are obtaining, and the total variable cost that will be able to give you total contribution. So how are we able to get it? So it can be obtained from the following formula. We can get total contribution from total sales revenue minus total variable cost. We can be able to get that, to get it through that formula, or we can also be able to get it, or we can also be able to get total contribution from CM. CM is the contribution per unit, imagine, times the number of units. So you can either use any of those formulas for you to be able to get total contribution. So total contribution, total sales revenue by total variable cost. You can also get it, or you can also CM, which you had seen here. CM is the contribution per each unit. If you multiply it by the total number of units that you have produced, you can also get total contribution from there. Number 3 is the CS ratio. CS ratio stands for contribution sales ratio. CS ratio. So CS ratio, CS. This is contribution sales ratio. Contribution sales ratio. We simply write it as CS ratio. And what is it? You say this is. Say this ratio indicates the amount of contribution. It indicates the amount of contribution. It indicates the amount of contribution for every unit of sale. It indicates the amount of contribution for every unit of sale. So it indicates the amount of contribution for every unit of sale. So it can be, as I said, it is obtained from the following formulas. So we have CS ratio. You can get it from total contribution over total sales revenue, or can also get it from CS ratio. You can also get it CS ratio, and also obtain it from CM, that is contribution per units, over the selling price. Selling price here is actually, remember, is the selling price per unit. So you can also get it from the CM over the selling price. You still get the same answer. You still get the same answer. Number 4. Number 4, we can talk about, of course, before we go to position, we can say profits, and you say this is the difference between the total sales revenue and total cost. It is the difference between the total sales revenue and total cost. It is the difference between the total sales revenue and total cost that will give you profit. Now, I know it looks obvious, but there is a reason as to why, of course, it is here. Now, we can obtain it from the following formula. Of course, you know profit is equal to total, and I want you to pay attention here, total sales revenue minus total cost. Pay attention here, total cost. You know, again, this is total sales revenue minus total cost is a combination of what and what? Fixed cost and variable cost. So you can have total variable cost here plus fixed cost. Simple. If we open the brackets, we shall be having total sales revenue minus total variable cost minus, when we open the bracket, this becomes minus, minus fixed cost. But we had said that this bracket is what? What is this bracket? Total contribution. Total contribution says sales revenue minus total variable cost. That's what it says. We can then summarize and obtain our profit as being total contribution minus fixed costs. And so this is our formula that we need to take into account when we are talking about management accounting. Total contribution minus fixed cost will be able to give us profit. Number 5 is break-even point. Break-even point. 5 is break-even. Break-even point. Break-even, so break-even point. B is actually break-even. You can even write in full. You can even write it in full. You don't have to write in short. So you can also write in full. Break-even. Break-even point. You say this is a point where this is the point where the sales revenue are exactly enough. If you say are exactly enough to cover for the cost, to cover for the total cost. The sales revenue are exactly enough to cover for the total cost. The sales revenue are exactly enough to cover for the total cost. You say at break-even point there is zero profit. At break-even point there is zero profit. So the profit is zero. There is zero profit because you can see the revenues are the same as the cost. So when the revenues are the same as the cost, you don't expect any profit, because if sales revenue are 2 million and the cost is also 2 million, what is the profit here? Zero. So that is the point where they say it's the break-even point. So we can say it can be obtained from the following formulas. So we can be able to use these formulas to obtain the break-even point. So we have number 1, item 1, break-even point in units. In units, you're able to count them. How many items are we producing for us to be able to break even? So break-even point in units is simply the fixed cost over the CM. Now you know how to get the CM, the selling price minus the variable cost per unit. So you simply divide the total of the fixed cost for that farm, you divide by the margin, the contribution margin for each product. You are able to obtain the number of units that you should produce for you to be able to break even. Are we together? Number 2, we can have break-even points, but now in shillings. Break-even point in shillings. Break-even points in shillings. I hope my sheet is going around. The attendance sheet. Eh? What? Which one? This one? Eh, you? Oh, I explain it. What I'm saying in units is that how many, let's say you are producing breads. That's how you are producing breads. So I'm producing breads. This one, breads. Breads. Now each bread is going for, let's say each bread is going for 100 shillings. This is the price. The price is how much? 100 shillings. Per bread is the per unit I'm talking about together. Let's say the variable costs of producing bread, let's say is 60. Is how much? Say 60 together. Then the costs, you're talking about fixed costs together. Probably the rent you're paying. That would be the fixed cost plus salary that you're paying for the government employees. Suppose they are 1 million. Let's say they are 10,000. Let's say just talk about 10,000. So this is fixed cost. Fixed cost. Fixed cost. So you are asking yourself, How many should you be able to produce in such a way that you don't go into loss, but you also don't generate any profits? We are saying how many units, the units are how many breads? 100 breads, 2 bread, 3 bread, 3 bread. How many bread? That's the breaking units together. So in this case, if this is the arrangement, then we shall be able to get how many breads are we able to obtain to produce to break even. The fixed cost how much? 10,000. We have said CM, senior, and the CM is price minus that. So it is 100 minus 60, senior. So this gives you 10,000 divided by what? 40. This gives you how many? We want to demonstrate whether this is true. Calculator. Hii ni ngapi? 250. So 250 breads. 250 what bread? Units. We are supposed to produce 250 breads for us to be able to break even. Let's see whether that's going to be correct. We know that the cost, total cost, is fixed cost plus variable what? To survival. So in this particular case, the fixed cost was what? 10,000. So it is 10,000 fixed costs. What is the variable cost? Because we are producing this 250. So the variable cost will be 60 times 250. So 60 times 250, because remember the fixed cost is not changing. It remains the same regardless of the level of activity. So the variable cost will be what we are producing 250 bread, but for each bread we are incurring a variable cost of 6. So 60 times 250 gives us what? 2,000. 15. So 15 what? So the total cost we are going to incur is how much? That's the cost. Then let's see. What's the revenue that you're generating? The total sales revenue, total sales revenue will be, you may produce 250 breads. So 250 times the price of the bread was how much? 100. 100. That gives you how much? 25,000. How much are we having here? So you can see cost is the same as the rate. It is the break-even point. Are you together? And that is what we say break-even point units. How many items, whatever of the product you're producing, should you be able to produce in such a way that you're able to break even? So that the revenue that you're generating are enough basically to cover for your total cost. So that's that. So we proceed with our discussion. So we say we are on the break-even point shillings. It's given by fixed cost over CM, SAFA, times the selling price. It is like you obtain the units and then you multiply by the selling price. You are able to get the break-even point in shillings. But this break-even point in shillings can also be obtained by simply break-even point in shillings. We can also get it from break-even point in units times the selling price. You can see this is in units, isn't it? So it's break-even point in units. You can as well just multiply the selling price, you get it still. We can also obtain this from break-even point in shillings, can also be obtained from fixed costs over CS ratio. So you can also get it from that formula. You will be able to get the same answers. For fixed cost over CS ratio, you are still able to get the same answer. So all these three, break-even point in shillings, all these three. So it's important for you to master all the formulas, because you may have a question whereby this is not possible, but this is the only possible option to use. So in which case you actually have to only to use that option which is basically possible in that particular case. So with this, how you're able to get the break-even point. Yes? Ask. I'm the one here. What are you asking? The formula. Somebody to remind us of what I said about the CS ratio? It is in total it's called what? Contribution, sir? What is it? It shows what? For every of sales, isn't it? So that's why if you start to divide by, that's why we are saying we operate by total contribution or total sales, revenue, or CM over selling price. So for each unit of sale, or for every one shilling of sale, how much are you getting in terms of the contribution? We proceed to number 6 question. There's a question here. There? Where? Where? Upper. I pardon you here. Look here. Break-even point units is what? Fixed customers here. Unapata units, ndio? So instead of going all this direction, this is already break-even point units, ndio? Upper. So you just multiply the selling price. So this is break-even point units, so upper. So instead of so you just multiply whatever you got there times there's the selling price per unit. You get it? Are you together?
Yes.
Any question? Any query? Yeah. Yeah. For every unit of sale, for every unit. Nikakupatia formula, si ndio? Nikasema the first formula ni gani? Total over total what? Because revenue is in shillings, si ndio? See, revenue is in shillings. Yeah, so it means for every amount of one shilling that you are selling, how much are you getting as contribution? For every unit of shilling that you are selling, how much are you getting as contribution? Together? Are you together? How about the pattern? If the total contribution, let's say, if you know how to compute total contribution, how do you get it? Total what? Minus? There, now, in that case, suppose this is the contribution is 100,000. So now the sales revenue, let's say, suppose that the sales revenue, let's say, is it can be anything. Let's say it is 200,000. Are together? So this gives you what? This gives you what? 0.5. Senior. It shows that for every 1 shilling that you are obtaining from sale, there's a contribution of 0.5 shillings. Are together? Yeah. So I hope that has been addressed. Any other question? Any other query? If you have a concern, you raise up your hand and you ask. Somebody says somebody else something? Because so where are we? We are number 6. Yeah? We are number 6. So number 6 is on the margin. What did I say this is? Margin of safety. So we are on the margin of safety. So number 6, you write in full, margin of safety, but you write in full and then you put that in brackets. And you say this is the difference between, it is the difference between the actual level of activity, the difference between the actual level of activity, the difference between the actual level of activity and the break-even level of activity. The difference between the actual level of activity and the break-even level of activity. The difference between the actual level of activity and the break-even level of activity. I have given an example that if you are selling 800 units and the break-even point is actually 300 units, for example, the difference there gives you the margin of safety. So you can say it can be obtained from the following formulas. So you can have the margin of safety in units. Margin of safety in units is simply the level. The level of activity is actually the sales units that you're making. So the level of activity, in units minus the break-even point in units. you are able to get the margin of safety in units. We can also have the margin of safety in shillings. And where that is the case, then we have the level of activity in shillings. So we convert your sales in shillings minus now the break-even point in shillings. You can also have margin of safety as a percentage. You can also have number, so this is number the first item, second item. You can also have margin of safety as a percentage. So how do we get it? It is the actual level, of course, the actual level of activity or the level of activity minus the break-even level of activity over the actual level of activity, everything you multiply by 100. I want you to know something there. You can see here I'm not indicating the use of the shillings. When it is a margin of safety in a percentage, everything must be uniform. If the level of activity is in units, the break-even point has to be in unit, and this has to be in U. If they are in shillings, then this must be in shillings. We cannot have actual level of activity in units and then break-even point in shillings. No, there has to be uniformity. If you are dealing with shillings, so everything must be in shillings. If you are dealing in units, everything must be in units. The percentage, the MOS will basically be the same. Next item, any question? So up here today, so we proceed. And we have number 7. 7 you say profits. So you don't say profit, you say sales. Sales at target profit. Or at times also you call it desired profits. Now, when we say the sales at target profit, we are simply saying that as a firm and as managers in this firm, we wish to generate a given amount of profit over a given period of time. So we are asking ourselves, how much should we be able to produce to generate that particular sale, to generate that particular profit? And that is what we refer to as sales at target profits. So you can say this is the level of sales. It is the level of sales. It is the level of sales. It is the level of sales where the firm may desire or may wish to generate a given amount of profit. A given amount of profit. So you wish to generate. So you ask yourself, I want 2 million profit. How much should I produce for me to be able to get it? Sales at target profit or desired profit. So how are we able to get it? You can say it can be obtained from the following formulas. So we are able to get it from the following formulas. So we have sales at TP is target profit in units. Now you will notice that the formulas for this, we are actually adjusting, modifying the break-even formula. So sales at target or desired profit is simply the fixed cost plus that target profit or desired profit over the CM. You can see break-even point in units requires the same fixed cost over CM. So on the fixed cost, we are simply adding that profit that we decide to generate. And then we divide by the CM, you're able to get the units that you should be able to produce and sell for us to be able to achieve that desired amount of profit. We can also have sales at target or desired profits. Remember, you can write it desired profit or target profit in shillings. And remember, we have said we are just so on the formula that we have seen for fixed cost, we are simply adding for the formulas that we have seen for break-even point, we are simply adding that profit to the fixed cost. So in this case, you can have in shillings fixed cost plus that target profit over CM. Then everything here we multiply by the selling price. Si tulisema break-even point in shillings ilikuwa fixed cost over CM times selling price, ndio? So I'm saying here for this one we are simply adding that profit that we desire to the fixed cost. So we can also get it on, can get it from sales at target profit in shillings, can also be able to can be obtained from sales at target profit in units times the selling price. We are still getting the same thing. Or you can also get it from sales at target profit. You can also in shillings, you can have it fixed cost plus that target profit over the CS ratio. You are still able to obtain it. 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 Sales at target profits in shillings. So sales at target profit, of course, that was in shillings. That was in shillings times the selling price. You can take whatever you got there, then you multiply by the selling. So we are saying here, in this case, whatever you got here, you can just take it directly here, and then you multiply the selling price. You'll be able to get the sales at target profit in shillings. So that's that. Any question? Any question? Any question? So we want to clear this by looking at briefly the multi-product situation. Then we look at certain past papers, and by that time, probably the time will be up. So I'm having this. So this is what I've analyzed here. Is about a single product situation. I want to look at a multi-product situation, and then probably I look at one or two questions that pertains to this. Can see the time is going. So you can say that for a multi-product, comma, break-even can be obtained from the following. Can be obtained by the following. Can be obtained by the following. By the following formula. The following formula. So we have the break-even point for a multi-product. It means you have A, B, C, D. So we shall be having the fixed cost, of course, in units. In units, we have the fixed cost over the weighted contribution margin. Weighted contribution margin. Now, we may get to understand what is this weighted contribution margin. Suppose we have this product. Suppose we have product A, product B, and product C. And we have the selling price. Selling price for this, they are in shillings. Let's say this is 100. This is 80. And we suppose this is 60. Suppose variable cost per unit. Variable cost per unit. For each, let's say this is 40. Let's say this is 30. let's just say this is 20. You are able to get the contribution for each in each case. How much is the contribution for A? Contribution margin, huh? 60. This one is 50. This is 40. We have talked about somewhere about the sales ratio, and we had said it is the ratio, the proportion which you are selling. Suppose the ratio is 2, let's say to 1. That is, let's say this is 2 to 6 to 4. This can be narrowed down, senior. To what? 1, 3, 2, senior. So suppose that is the proportion. So if we were to get the weighted contribution margin, how are we to do it? In this case, the weighted contribution margin will simply be the contribution margin for A, which is how much? 60 times the proportion of A in the total is how much? 1 over 1 plus 3 plus 2 ni ngapi? 6, ndio? So it is 1 over 6 plus 50, that is 50 times the proportion of B in the total is what? 3 over 1 over? Oh, 1 over 2 because it's 3 over 6, ndio? So it is 1 over 2, correct? Plus 40 times a third. That will be able to give you the weighted contribution margin. So you use that formula to get the break-even points. And the units that you shall have obtained the break-even points will be for all the items that you are producing. If now you are to get each unit in the break-even composition, you will simply come here and you take A 1 over 6 times that total unit, those units. 3 over 6 times those units, and 2 over 6 times those units. If you are to convert them in shillings, whatever it is that you get here, you can multiply by the selling price. These units you have to get here, you get multiply the selling price of that, this by the selling price of that, and you get the break-even point in shillings for a multi-product situation. So in this case, we have said we can be able to get the weighted contribution margin from the contribution margin of 1 times the proportion. Can say contribution margin of product A times the proportion or the ratio. Can talk about the ratio of product A plus the contribution margin of product B times the ratio, of course that is the ratio of product B, plus the contribution margin times the ratio of product what? C, etc. So you just come here, break-even point units, this one times that, and then whatever you get here, those are the units. You get told down the break-even point in shillings, you simply get each total, the units in each for each item based on the proportion, and then you're able to multiply those units with their respective selling prices, and you add the total, you get the total, the break-even point in shillings for several products. Now, I want us to proceed and look at certain questions. And you have the past papers. Amuna, you don't have them. Okay, if you don't have them, let me. I think there are 2 brief questions here. Yes. So, yes. So I'll be. Yeah, can I add somewhere? I think there's brief questions. Just a minute. So you'll be having the past papers, don't mind. You'll get them in the meantime. So the one that I want us to share here, to do here, is actually a brief questions. I'll just show what it is here. It is right down there, December 2023, question 2A. December 2023, That is CPA. December 2023, question 2A, this CPA paper. December 2023, question 2A. Just want to read what it is, so that you so December, so you talk about December 2023, question what? Question 2A. So this is, it's actually a brief question, you can even write it down, it's very brief. It's very brief. So this is what the question is talking about. You've been told the management accountant of Alma Limited. It's a very brief question. So the management accountant of Alma Limited provided the following profit statement. Provided the following profit statement for the year ended 31st October 2023. For the year ended 31st October 2023. For the year ended 31st October 2023. So we have there the revenue. The revenue actually is sales revenue. So the shillings million. This is 60. This is total cost. Total cost is 48. Then we have 12. The 12 there is the net profit. That's the statement that we have. Then you've been told down there the contribution sales ratio. The contribution sales ratio is 50%. 50%, remember, is 0.5. The contribution sales ratio is 50%. Sales ratio, that is. The contribution sales ratio is 50%. Then required down there, 1. Calculate the break-even sales. Calculate the break-even sales, that's the first item. Calculate the break-even sales, the first item. And number 2, calculate the margin of safety, the second item. Calculate the margin of safety, the second item. Calculate the margin of safety, the second item. So the first item is calculate the break-even sales, and number 2, calculate the margin of safety, the second item. So how do we go about this? How do we go about that question? How do we go about doing the question? How do we proceed? Somebody? How do we proceed? How do we proceed? How do we proceed? Somebody? So let's do it together, because I can see if I was to give you time to look at those, probably we would time is Taisha, we have not done anything. So you've been told that the CS ratio is Ningapi. Its ratio is 50%, and you know the 50% is 0.5. That's 0.5. So you know you can CS ratio. This ratio. How do we get it? What's the formula? It is contribution. Total contribution. Total contribution over total sales revenue. Total sales revenue. Now in this case, it is 0.5 is equal to total contribution divided by total sales revenue ni ngapi? 60. So total contribution ni ngapi? 0.5 times 60. This gives you what? 30. Total contribution is 30. Now, how do we get total contribution? Of course, we must be getting the equilibrium. The first one was asking about what? Break-even point, and the other number 2, margin of safety. Correct. So you have to, your mind must be there. So total contribution here is what? Is what? How do you get it? Total test revenue, total variable cost. Together, we have the total contribution here, isn't it? So 30 is equal to total revenue is equal hapo. Ni ngapi? 60 minus total variable cost ambayo hatuna, si ndio? We can work backwards, si ndio? So you get the total variable cost to be what? 60 minus 30. So total variable cost is what? 30, si ndio? But we know total cost is a composition of fixed and variable. That's we know. Total cost is 48. Variable is what? Fixed ni ngapi? Are you together? So fixed. So total costs. So of course you know but total cost is equal to total fixed costs plus total variable costs. But variable cost is that, therefore fixed ni ngapi? 48 minus 10, that is 80. Now you have fixed cost. Right together. With the fixed cost now that you have, you can be able to get a break-even point. Fixed cost over CS ratio. Yeah? This is in shillings. Can you check on those formulas? CS ratio. All those formulas you cannot use except the last one. All those formulas you cannot use here except that which is saying fixed cost over CS ratio. So that is in shillings scale. Even these figures are what? So these figures are in shillings. Are these figures not in shillings? Shillings for really? That is break-even in shillings that they are requiring. Right together. Right together. So all those formulas you cannot use except what? One. So you come here and say, the break-even point in shillings. They are in shillings. So that's why they ask in shillings. So it is their fixed cost over the CS ratio that you can use to get this one. So it will be 18 over 0.5. That gives you how much? 18 divided by 0.5 ni ngapi? 36. So the break-even point 36 million. Are you together? Yes. Break-even point 36 million. Then, question, ask me any question. Number 2 ni nini? Margin of safety, and again this figure in shillings. So it's in shillings. So margin of safety in shillings. And remember the items are in shillings. Yeah? Which one? Where? Break-even point in shillings. Fixed cost over CS ratio. And CS ratio tuko nayo. So our fixed cost umepata. Over that, we are able to get now what the break-even point in shilling is. Are you together? Or we are lost? You aren't lost. Now, margin of safety. Number 2, we are saying margin of safety. Margin of safety in shillings, we have said, is the level of activity in shillings minus the break-even point in shillings. So you simply come here. Margin of safety in shillings is equal to what? It is 60, sindio? 60 minus 36, sindio? This is the level of activity in shillings. So that is in shillings. So it's 60 minus 30. That gives you what? 24 billion. Are you there? So you must be tough for you to be able to tackle these questions. When we proceed to another question, we go proceed. This is also CPA. This is CPA. This April 2024. April 2024. April 2024. This is April 2024. Question 3B. Question 3B. Question 3B. You are still, I think this is ni long kidogo. You can unaweza kuchapa picha haraka, then I get it back. Question 3B. Instead of you, so unaanza huku alafu unaenda huko, sawa, naisha huko haraka. Anza huko na question 3B. Quickly, I'm remaining with around 10 minutes to go, and I want to clear that question. So it's a long story. That's why I'm saying you take a picture, then as we do it, and you are able to see what we are doing. Question 3B, sir. Oh, for group. You can, sir. So just take it and then send it to the group. That's even easier now. Just send it to group. You can write over there up there MA. Andika MA huko. Hapa juu. M stroke A. Huko juu tu. To know what the unit is. M stroke A. Ishaenda kwa group. Unaweza tuma hata kwa hiyo general group. So there are also guys who are online, so they can also be able to see. So that's can you confirm that you have seen it? You have seen it. So now that you have seen it, we can go through it together. So I'm going to read it, and we follow together. So you say luxury weekend country park is an entertainment park that offers individual and family entry tickets. The tickets include a meal, 3 types of beverages, and unlimited use of the swimming pools. Luxury weekend country park has the following tickets prices and a variable cost for the year 2024. So there are two. Of course, it's like there are 2 products there, the individual and their family. So selling price per ticket for individual it is how much? And for the family it is what? Then we have variable cost per ticket there. So the variable cost per ticket there, we have the cost of meal, direct labor, variable cost of beverages, swimming pool. So in this case, they have really computed for you the contribution margin. They have computed already for you the contribution margin, which is the individual is 600, and for the family it is 1,100. So they have just taken the total contribution, the variable cost per unit. That is by adding all those items, they are subtracting from the selling price up there. They are able to get that. Then you have told the other side apportioned annual fixed cost. So apportioned annual fixed cost is 33,75,000 for which category? For individual? For individual. Sasa. And they have 41,25,000 for what? For family. Then the total fixed cost is how much? 7.5 million. Senior. Then you've been told the expected tickets to be sold. We have the individual is 6,000 and the family is how much? 4,000. Senior. giving the total of how many tickets? 10,000. Then additional information, you have been told all the assumptions of the cost value profit analysis are valid. So which means they are applying all the assumptions that we have discussed. Number 2, total sales mix is currently generated. So if somebody talk about the sales mix, is currently generated by 2 types of tickets in the following proportion. How much? 60% and 40%. That is gives you 0.6 and 0.4 together. Now you have been told down there, compute the weighted average contribution margin at the current sales mix assumed above. So here, so there, you have been told to compute the first thing, compute the weighted average contribution margin. So that's number 5. Compute the weighted contribution margin. How many products do we have here? 2. So we have seen how to get it. Senior, contribution for each item times the ratio, the proportion. So we simply have here the individual contribution of the already compute that for you. So you say 600 times proportion yake is 0. What? 0.6 plus what? Plus what? 1100 0.4. That gives you inakupatia ngapi? 600 times 0.6 times inakupatia ngapi? As one figure. Give me one figure for this. This is a multi-product because there are more than one product. Calculator, I want one figure for this. 8 million. 800. Together. 8 you have your tick. Then the next item you've been told, calculate the total number of tickets that luxury weekend country park must sell to break even. You come here, we say they break even in units because they are tickets, and these are several products. So it is the fixed cost, and this fixed cost is total fixed cost over the weighted contribution margin. The total fixed cost, your 10 is 7.5, 7,500,000 divided by 800, you get what? You get what? 86? 93.70 tickets. Unaandika tickets because they are tickets. You have your tick. You proceed. Margin of safety in what? So that's number 3, isn't it? The margin of safety in units. So we have number 3, the margin of safety in units. The level of activity in units minus the break-even point what? In units. But this total, so the level of activity, what's the total? What is the total? It is, the total is 6,000, 4,000. You not see? Siko huko chini. Expect ticket to be sold. Siko hapo. Expect ticket to be sold. It is 6,000 and 4,000. So, Sindio? So the total is 10,000 minus the break-even point is 93.75. 93.75. And you get this to be how much? 625. 625 what? Tickets. Because they are tickets. So this is the margin of safety for the whole company. Then you have been told the last one. Calculate the number of individual tickets and the number of family tickets that luxury weekend country park must sell to break even for. So they want each unit. They want each unit. Very easy. You simply know that this one is total. So after the individual tickets and family tickets. So you simply come here and get the individual tickets. Ilikuwa proportion yake ni ngapi? Oh, the proportion here. 0.6. So it is 0.6 times 93, 75. You get what that is. You get the family tickets. 0.4 times 93.75. 5. You get how much here? 56. 25, and this one is 37.50. If you add all this, what are you getting? You get your tick. They are easy, isn't it? Yes. The concept must be at your fingertip. So that's the end of our class. That's the end of our class for today. I think I will not consume much of your time. It is exactly 8, so I will not take any of your time. So I'll see you next time, God willing. Yes, thank you.